Welcome to Mayor Brown's Tech Talks podcast. Each podcast is designed to provide insights on legal issues relating to technology transactions and keep you up to date on the latest trends in data, digital, outsourcing, and software by drawing on the perspectives of practitioners who have executed technology transactions around the world. You can subscribe to this series on all major podcasting platforms. We hope you enjoy the program.
Hello, listeners. Today's topic is open banking and what to make of it. My name is Julian Dibbell, and I'm your host. I am a senior associate in Mayor Brown's Chicago office. My practice focuses on technology transactions. Our guests today are my colleagues, Rohith George, Oliver Yaros, and Chris Chapman. Rohith is a partner in Mayor Brown's technology transactions practice and is located in our San Francisco office. Oliver and Chris join us from our London office. Oliver, like Rohith, is a partner in our technology transactions practice, and Chris is a partner in our global financial services regulatory and enforcement and litigation and dispute resolution practices. Welcome, Rohith, Oliver, and Chris. Why don't we get started? So the topic of today's podcast is open banking. Rohith, I want to direct my first question to you. Set the stage for us here and tell us what we're talking about. What is open banking?
Yeah, sure. Open banking refers to the practice of banks allowing third-party financial services companies access to customer account information, transaction history, and other financial data through APIs. What does that mean? Well, historically, your financial data was closely guarded and protected by your bank with access granted in a limited fashion to payment processors for payment initiation purposes, and then access granted to you through your online account so that you can manage your own finances. Of course, your financial data is a treasure trove of information, and over time, fintechs and other financial services companies have sought access to that data in order to provide a wide range and variety of financial services. For example, looking through your transaction history in order to analyze your spend and help with budgeting. So there are a number of different use cases, but open banking really now is the industry's way of providing that type of access to data in a safe, secure, efficient, transparent way. The customer-centric view on this would say that once this type of financial data can be routinely shared, then it becomes easier for customers to get the financial services that they want from the service providers that they prefer to use, which ultimately increases competition, it increases innovation, it increases access to financial services. So at a high level, that gives kind of a 1,000-foot view of what open banking is all about.
Okay, how about some examples of what open banking enables?
Sure. I mentioned budgeting. Financial management tools are a popular use case. You can grant access to a third party to pull up all of your transaction history from all of your different banks, analyze all of your spend, sort it into categories, help you manage your finances. And whether you're a consumer or a small business or otherwise, I think Mint.com is the most popular, commonly known player in this space. There are also multi-banking apps, which are getting popular in Europe, that allow a single app to manage all of a customer's account in one place. So instead of having your Chase account and your bank account and different apps for everything, there are multi-banking apps that allow you to initiate transfers between places, initiate transfers out, all through a single kind of website or portal or app. Lending and underwriting is another area where open banking can streamline processes. When you take out a loan right now, or historically, you have to provide details regarding your finances to show your ability to actually repay that loan. And that process can be cumbersome. It requires collecting statements regarding salary, debt, finances, and then those statements get scanned or the PDF get sent to the lender, and the lender then needs to ingest all that information into their underwriting systems. With open banking, you can provide the lender with one-off access to a certain number of months of income and spending history, for example, and then that gets pulled and categorized and populated much more efficiently in the lender's systems. So this process then becomes a much smoother one for the customer. It reduces friction. It results in better data for the lender as well. And most of what I've just mentioned are read access APIs that allow third parties to read data from the customer's account. There are also write access APIs that allow customers to initiate funds transfers through the actual third party. So, for example, apps that automate bill payment or optimize interest earning. There are also micro-saving apps that automatically round up, your purchases and transfer the rounded up amounts to an interest earning account, et cetera. We could go on, but those are just a few examples of some of the use cases for open banking.
Okay. Now, I understand in recent years there have been some interesting developments on the regulatory front in the EU with respect to open banking. Chris, can you speak to that a little bit?
Yes, that's right, Julian. A new European directive, the Revised Payment Services Directive, or PSD2, has been passed and implemented in Europe and in the UK recently. And one of the things that does is it encourages open banking. So that's one of the things we were going to talk about today.
Okay, obviously a lot of move towards this open banking model. What are some of the risks, though? I mean, there must be some for banks in opening up this data to other companies. Oliver?
Yeah, that's right, Julian. I mean, in opening up this data, every company's immediate concern, at least in the EU and UK, is how you do this in a way which complies with, for example, the GDPR and data security requirements here in Europe. The GDPR is a European regulation that requires financial institutions and, frankly, any organization to protect the personal data that it has about individuals, and to only disclose that where there is a legal condition for doing so. It has been argued that PSD2 and the GDPR are fundamentally opposed to each other. One brings in data sharing requirements and the other restricts the ability to share data. And this has led to companies worrying that by complying with one, they might be risk of breaching the other. However, I think PSD2 and GDPR can also be seen to be two sides of the same coin. That coin is increasing consumer choice and control over their own data. One of the risks is liability for breach of the GDPR. That's something a lot of businesses are concerned about. Banks and third-party providers, or TPPs as they're called under PSD2, they will have access to each relationship that they're being asked to share data about on a case-by-case basis. And they can decide whether they are processors, controllers, or joint controllers in that relationship. So PSD2, for example, provides that banks can't refuse TPPs access to customer accounts if the third-party provider refuses to enter into a written agreement with the bank. Without a DPA in place, that's a normal agreement that you would enter into under the GDPR. Without that agreement between banks and the third-party providers, banks are then limited in their ability to agree on what the appropriate allocation of responsibility is between them about sharing that data. And it's harder then to demonstrate accountability for when that data is shared and used. It also creates questions around who is liable for the third-party provider, or even a fourth-party breach if that data is passed on. The customer is most likely to take their grievances to the bank, but it's yet to be seen how responsibility is actually going to be divided up on most occasions. Another liability risk is for a fraudulent or erroneous transaction. It is the bank that must refund any amounts that happen because of unauthorized payments. If the third-party provider is liable, the TPP is supposed to indemnify the bank immediately. While PSD2 requires the third-party providers, who are often thinly capitalized, let's be honest about it, to hold professional indemnity insurance or some other comparable guarantee against their liabilities, issues, of course, arise when neither the third-party provider or the bank believe they're actually at fault. And the bank is at risk here if they've already paid out to the customer. The FCA has already commented that for payments initiated by the third-party provider, the burden of proof would be on the third-party provider to demonstrate it wasn't responsible for an error. But there's also a voluntary dispute management system set up here in the UK, for example, by the open banking standard to handle such disputes. By contrast, I think in the US, where open banking is developed without specific government intervention, banks and third-party providers commonly enter into bilateral data access agreements.
And I was just going to add to that, Ollie, in terms of some of the risks we think regulators are seeing in particular in Europe. And the two really are the two key ones are the ones that Ollie has mentioned. So GDPR compliance and data and cyber security. But they are also concerned about other risks, especially risks for consumers and market integrity. And financial crime in particular is high on the agenda. Ollie mentioned that third-party providers are often thinly capitalized, but by the same token, they're also likely to have smaller and less experienced compliance departments, and they may not have the same level of sophistication as banks and other large institutions in terms of their financial crime defences. And that's not just defences against external threats like cyber hackers, but also against internal threats like employee or third-party fraud, or inadvertently assisting money laundering or breaches of sanctions. And Ollie talked a little bit about responsibility and liability for fraudulent and erroneous transactions falling back onto the bank. Something else to bear in mind in Europe, and particularly in the UK, is the risk that regulatory responsibility might also be traced back to the bank or other regulated provider from a third-party provider.
Okay, well, given all that, given the risk, why are banks actually opening up their data through these open banking initiatives? What's driving this trend? Chris, maybe you can take that one.
It's the rewards, Julian. We've talked about the regulatory risk, but at the same time, the regulators around the world really are all saying how keen they are to allow innovation. They're trying to balance that with protecting consumers in the market, which is not easy. But we can see laws like PSD2, and we've seen similar laws outside the EU, for example, in Australia and Japan. And I understand, although there's not the same sorts of laws in the US, there's still some regulatory pressure to allow open banking. So there's all of these enabling regulatory mechanics, and that's really putting pressure on banks and other large institutions to properly engage with this innovation, or they risk being left behind by their competitors. And there really is a tremendous amount of innovation in the global financial services sector at the moment. And we see even big and very, very traditional players investing a lot of money in these sorts of services to try and keep up.
Yeah, I would just add that, in addition to the regulatory pressure that Chris was just mentioning, the desire to keep up and the desire to innovate, there are also some operational and strategic reasons for banks to move towards open banking as a standard. The genie is kind of out of the bottle already. Customers have already been providing third parties access to their financial data. They've just been doing it through what's called screen scraping. So, what's that mean? Well, until recently, if you wanted to give a third party access to your bank data, you typically provide the login and password for your account to the third party, and that third party would then use the credentials to log in as you, and then collect the information it needs through screen scraping, which is basically a process by which the data that's in your online account is copied or scraped to an external database. The problem is that there are a few issues with this process from everyone's perspective. First, from the customer's perspective, the third party now has access to your passwords and to other security information for accessing your bank account, and that's the risk. It makes your account info actually more vulnerable to loss. You may use the same password in multiple places. It may also expose those other places as well, if that's ever that type of information is ever lost by the third party. It also ultimately grants the third party provider access to your entire account, which may be overexposing the information that you don't necessarily want to expose for the service that you're trying to obtain from the third party provider. So there's some downsides from the customer's perspective, but from the third party provider's perspective, screen scraping can also be resource intensive. It involves, downloading large pools of data that need to be retrieved. And if the bank then makes a small change to their app or to their portal, that can also break the screen scraping for that particular bank, and it requires time and effort to correct. So, there are some downsides from the third party's perspective as well. But even from the bank's perspective, the entire process is leaking data to third parties while doing an end around the bank itself. It's usually typically against the bank's policies for customers to share their account information or their login, their passwords, and for very good reasons. It's intended to protect the bank and also for the bank to keep control of its environment and be able to efficiently protect the customer. But despite these issues, since there weren't any alternative screen scraping has been used for years and years. But this is where open banking comes into play as an alternative. Regardless of the regulatory pressure, open banking can be more secure because there's no passwords or security information that needs to be shared with third party. There can be finer control over the type of information that the provider is granted access to and for how long. And then, the APIs allow much faster and more efficient access to the data because they're at the database level. So they're unlikely to break at any point because of changes to any customer-facing portals or websites. And then because the connections are directly between the bank and the third party, the bank is involved in the process of sharing that data versus it being kind of an end around to the customer portal. So there are advantages for banks in embracing open banking with or without the pressure from their local regulators, which is why I think, in addition to what Chris mentioned, it is one of the reasons why we're seeing banks in jurisdictions like the U.S. also moving forward with open banking initiatives, regardless of, there not being any specific laws on that just yet.
Okay, so for one reason or another, banks are diving into this whole open bank landscape. As they do so, what are some of the key issues or key challenges that they're going to face? Oliver?
Well, I think one of the key challenges that banks are going to face is a number of consents that have to be obtained by both parties involved, both under the PSD2 directive and the GDPR. So the PSD2 requires a third-party provider to obtain explicit consent before providing account information or payment initiation services. But this is on top of the GDPR requirements that the banks and the third-party providers have a lawful basis for processing any personal data that is involved in the transaction, both in the transfer of the personal data and either side, in terms of how both sides uses the data. So these lawful bases are also likely to rely on consent, but they don't have to necessarily rely on consent from a GDPR perspective. A bank will also need to validate the consents that third-party providers have got directly with the customer to ensure that the third-party provider is genuinely acting on the customer's behalf. So obtaining and managing all these consents is a complex process, made all the more difficult by the fact that there are different interpretations of what consent means. So, for example, under PSD2, PSD2 uses the explicit consent wording. We've got to obtain explicit consent, which the European Data Protection Board and the FCA, along with other bodies, have confirmed shouldn't be interpreted as meaning the same as explicit consent does under the GDPR, where it is often used for things like processing special categories of personal data like race, health, religious information, and would be a much more onerous standard to get to if we were looking for the GDPR standard of explicit consent. Another example of the difference between the two types of consent you might get is that consent expires automatically under PSD2, but not necessarily under GDPR, where it can be withdrawn at any time and can last different amounts of time. Another issue is that PSD2 only gives third-party providers access to payment accounts, but many account information service providers require access to other accounts as well, such as saving accounts, to properly function. Under PSD1, the forerunner to PSD2, third-party providers used screen scraping or reverse engineering technologies to access all the information that they needed. And there's no reason to suggest this would now be illegal under PSD2, but it does mean having to use different ways to access different accounts and manage all those processes.
And just thinking about other regulatory challenges and dealing with regulators, I think one of the big challenges is something I mentioned briefly before relating to regulatory responsibility. So we're seeing this in all sorts of regulatory regimes around the world, and an encouragement towards outsourcing, allowing outsourcing and allowing the use of third parties. And that, in a sense, is what open banking is all about. But there's also an increasing recognition from regulators that in order to police that effectively, they need to make sure that regulated entities will retain responsibility for compliance, or at least oversight of compliance. And that's especially the case, as will often be the case here, where the third-party provider is unregulated or where they don't have sufficient funds to compensate customers. So in the UK, there can sometimes be quite a lot of regulatory pressure for larger firms in the distribution chain to take financial responsibility for breaches or problems or wrongdoing caused by third-party providers downstream. And this new responsibility on established firms to police other providers, while at the same time trying to embrace innovation, can be quite a big challenge. And I think a lot of firms are struggling to come to terms with exactly what that will mean for the future.
Rohith, what about in the U.S.? How do the challenges look from our side of the pond?
Well, the challenges in the U.S. are not too much different than what Oliver and Chris just mentioned. The customer consent process is a critical, element of the overall scheme to be considered and addressed. The goal is to provide the customer with sufficient information to actually determine and consent to the scope of the data sharing. For example, the types of the data that can be accessed, the timing of the access, whether payments can be initiated, and so on. And as Chris mentioned, banks can't completely outsource their compliance obligations to third parties in the U.S. either. And the part that may be a little bit different is because in the U.S. there is no U.S. version of the PSD2 regulation as yet. It's left to banks and third-party providers to allocate responsibility and allocate risks for each party's role in the data sharing process. And that's typically done by entering into bilateral data sharing agreements, as Oliver mentioned earlier. The challenge here is, because a bank would have to enter into a data sharing agreement with each and every third-party provider, and because each third-party provider would need to enter into a data sharing agreement with each and every bank, all of which could have different requirements, because of this kind of model of requiring bilateral data sharing agreements can become very difficult to scale in a meaningful fashion. There could be thousands of third-party providers providing financial services, and there are certainly hundreds of banks that a third-party provider may need to enter into agreements with. But now that there are data aggregators like Plaid or Finicity and others, banks can now enter into data sharing agreements with the data aggregator, and the applications that are supported by the data aggregator can use the bank's APIs. But of course, this actually still only reduces the scaling challenge. It doesn't completely eliminate it, because there are still a number of data aggregators, and from the data aggregator's perspective, there are still a number of banks that the data aggregator would have to put in place agreements with, which can be challenging.
All right. So if you're negotiating one of these data sharing or exchange agreements on behalf of a bank or on behalf of a fintech, what are some issues to watch out for?
Yeah, I think the macro issue is, as Chris mentioned, the bank is a highly regulated entity, and absent any regulatory regime that allocates risk and reliability to the third-party provider, the bank is fully responsible for oversight and for compliance. And as a result, there are going to be some provisions that are required for the bank, such as around cybersecurity, privacy, compliance, audit rights, and so on. In addition, there are a number of issues that need to be addressed in the data sharing agreement, like negotiating appropriate limitations on the purposes for which the data can be used, what the respective obligations are of the parties regarding disclosures to customers, the consent process that we described, negotiating appropriate limitations on the actual scope of the access rights, what data can be accessed when, et cetera. And we often actually see obligations in these agreements to stop screen scraping, because that is a significant initiative, or that this type of API access is the exclusive method of access to data to the financial data, and that the third-party providers, as kind of a condition to agreeing to these types of agreements, will agree to stop screen scraping. And then, the other typical issues that, are not unique to these types of agreements, but are still critical, are around what the suspension and termination rights are for access to the data, and then also what the indemnification and allocation of liability is between the parties, and including, in the event of a security breach or a security incident.
Yeah, and I think by contrast, and it's quite an interesting contrast, UK and European open banking is much more reliant on the regulation as opposed to having data sharing agreements. So some banks do have terms and conditions at the point of access, i.e., an API that third-party providers use. But these are limited to disclaimers, no warranties, reserving the IP rights in data that is shared, excluding liability for loss from use of the APIs, and setting out what the prohibitions are when a third-party provider is seeking to use the API. So my primary concern in any data sharing style agreement that might be entered into is typically around topics such as enabling the bank to ensure that individuals can exercise their rights under the GDPR, such as the right to erasure of their data, and allocating responsibility for any processing where there is possibly joint controllership or a controller to processor relationship. So, how does one party notify the other in the case of an incident or data access requests? And of course, an agreement should also set out how liability is allocated to the extent that's possible, and how disputes might be resolved.
Yes, that is quite an interesting contrast, and all of this is very, very interesting set of developments. And from everything we've talked about, it seems like this is not a trend that's going away anytime soon. So going forward, what would you say are some of the issues or developments to keep an eye out for? Keep an eye on.
Well, from a regulatory perspective, as I've mentioned, I believe some of the biggest challenges will be around how larger regulated firms are expected to take responsibility for smaller providers. The key risk areas where they may find themselves liable for failings by others will be in some of the areas we've discussed. So GDPR, cybersecurity, and financial crime, as well as other consumer protection areas.
Yeah, and I agree with Chris that concerns about the responsibility for any liabilities that arise, whether that's from security lapses or misuse of data or inaccurate data being shared, those are some of the biggest risk areas that we'll see being addressed potentially by regulatory action or litigation in the future. But obviously, open banking is here to stay, and data sharing is certainly going to increase in scale and complexity as we look to the future.
Yeah, and I would say, just as kind of a closing remark, that from my perspective at least, open banking as a concept feels kind of like it's only at the beginning of some very significant changes in financial services. There are opportunities here for incumbents, for banks to create high-value financial platforms and ecosystems through new API-enabled models, and that may result in re-envisioning and reimagining what it means to be a bank, and it may involve, entering into some newer type of revenue models that were not previously available to banks. And then for newer fintech players, innovation is the name of the game, and some of the barriers are coming down so that they can leverage and put to use some very rich customer financial data, and that's all without having to obtain their own banking licenses. So some of the barriers are coming down as well. So assuming everyone's able to carry this off in a safe, secure, transparent way, at the end of the day, the customer wins, which, yes, is a big caveat, but I'm excited to see what the future brings.
Well, thank you, Rohith, and to you, Chris and Oliver, for that thoughtful analysis and valuable perspective. Listeners, if you have any questions about today's podcast or anything else related to technology, transactions, and the law, please email us at techtransactions@mayorbrown.com. Your question will be forwarded to the appropriate presenter for a response. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.